March 2009. The global financial system was dying. Lehman Brothers gone. Bear Stearns collapsed. Citigroup trading below $1. Bank of America down to $3. Wall Street was convinced these banks would be wiped out completely. Hedge funds were liquidating everything. Investors were fleeing to cash. The smartest minds in finance were screaming, "Sell everything." But one man was doing the opposite. While panic consumed Wall Street, he was placing the largest bet of his life, billions of dollars. All in on the banks everyone said were finished. If he was right, he'd make one of the greatest fortunes in financial history. If he was wrong, his career was over. His colleagues told him he was insane. "You're betting on dead companies," they warned. "These banks are going to zero." But he didn't blink. "The government won't let them fail," he said calmly. "And when the market realizes that, we'll make billions." 9 months later, he walked away with $4 billion. This is the story of that bet, and the man who made it. David Tepper. David Tepper was born on September 11, 1957, in Pittsburgh, Pennsylvania. This was not a billionaire household. There was no inherited wealth, no Wall Street lineage, no financial safety net. His father, Harry Tepper, worked as an accountant. His mother, Roberta Tepper, was an elementary school teacher. The family lived a traditional American middle-class life, where discipline, education, and steady work mattered more than ambition or risk-taking. Tepper attended public schools in Pittsburgh. He was not known as a prodigy, nor did he stand out academically at an early age. While his peers followed sports, Tepper followed stock prices. In 1978, he earned a bachelor's degree in economics from the University of Pittsburgh. His ambition was clear: he wanted to reach Wall Street. In 1982, he completed his MBA in Industrial Administration from Carnegie Mellon University. Tepper began his career as an analyst at the U.S. Treasury Department, gaining exposure to government finance but little market excitement. He then moved to Equibank as a credit analyst between 1982 and 1984, studying loan risk, defaults, and financial deterioration. One role proved decisive. At Republic Steel Corporation, Tepper confronted financial distress firsthand. Balance sheets were broken, assets were impaired, bankruptcy was unavoidable. Most investors avoided these situations. Tepper studied them. In 1985, at the age of 28, Tepper's career reached a turning point. He joined Goldman Sachs, not in high-profile deal-making, but on the high-yield bond desk, commonly known as junk bonds. These securities were tied to companies on the edge of failure. Throughout the late 1980s, Tepper became a strong performer within Goldman's high-yield group. By the early 1990s, he was widely regarded as a top performer inside the firm. But success created tension. Between 1991 and 1992, disputes over compensation escalated. Reports indicate Tepper sought a $14 million bonus, citing the value he had created. Goldman Sachs management disagreed. Negotiations failed. In 1993, at the peak of his career, David Tepper made a decision that stunned Wall Street. He left Goldman Sachs. Not fired, not forced out. In 1993, Tepper launched his own hedge fund, Appaloosa Management LP. The fund was founded with approximately $57 million in capital and headquartered in New Jersey, away from Wall Street's spotlight. When David Tepper launched his hedge fund, the strategy was clear from the very beginning. While most hedge funds chased momentum and market optimism, Appaloosa was built to chase collapse. From day one, Appaloosa Management LP focused on distressed and bankrupt companies, defaulted and high-yield bonds, corporate restructurings, and event-driven situations tied to credit dislocations. Appaloosa followed the traditional hedge fund structure, charging a 2% management fee on assets and a 20% performance fee on profits. Retail investors were not allowed. Capital came only from large institutions and ultra-high net worth individuals who understood the risks involved. By the late 1990s, Appaloosa had grown into a multi-billion-dollar hedge fund. Tepper developed a reputation as one of Wall Street's most skilled specialists in distressed debt, an area few investors truly understood and even fewer were willing to touch. In 2008, the global financial system entered freefall. Lehman Brothers failed in September. Bear Stearns collapsed earlier that year. Major banks lost 80 to 90% of their market value as confidence vanished almost overnight. Once dominant institutions were reduced to pennies. Citigroup, which had once traded above $50, fell below $1. Bank of America dropped to nearly $3. American International Group collapsed entirely and required a $180 billion US government bailout, the largest in history. Between late 2008 and early 2009, Tepper made one of the most aggressive bets of his career. Appaloosa built massive positions in Citigroup, Bank of America, Morgan Stanley, and American International Group, all trading near $1 per share. The downside risk was enormous. If the banking system collapsed entirely, Appaloosa would suffer catastrophic losses. In March 2009, markets finally reached their bottom. Then the reversal began. Over the following months, Citigroup rose several 100% from its lows. Bank of America more than doubled. AIG rebounded as restructuring plans took hold. Between 2010 and 2012, Appaloosa continued producing annual returns of 25 to 35%. Tepper's personal net worth crossed $10 billion. But markets change, opportunities fade. And the environment that once made Appaloosa unstoppable was quietly beginning to shift. By 2013, the momentum that had defined David Tepper's career began to slow. Appaloosa's returns slipped into the 7 to 9% range, respectable by industry standards. In 2014, performance remained muted. Appaloosa was no longer clearly ahead of the market. For the first time, Tepper was navigating an environment where patience alone was no longer enough. Then came 2015. For the first time in his career, Appaloosa posted negative returns, falling roughly 4 to 5%. The shock wasn't personal, it was structural. At the same time, heavy exposure to energy collided with oil's collapse from over $100 to below $40. In 2015, Tepper relocated from New Jersey to Florida, legally eliminating state income tax. The move reportedly saved him over $100 million annually. New Jersey's governor publicly criticized the decision, and national headlines framed it as wealth-fleeing responsibility. Away from markets, change continued. Tepper divorced Marlene Resnick in 2016 after decades of marriage and 3 children. In 2019, he remarried Nicole Bronish in a private ceremony. By 2019, managing outside capital no longer appealed to him. Then came 2020. When COVID-19 crashed global markets, losses followed briefly. True to form, Tepper leaned into panic once again. By year-end, much of the damage had been reversed. The era of dominance was over. The instinct was not. In May 2018, Tepper entered a new arena. He purchased the Carolina Panthers for $2.275 billion, the second highest price ever paid for an NFL franchise at the time. The sale followed misconduct allegations against previous owner Jerry Richardson, opening the door for Tepper's move into professional sports. The acquisition was about more than football. It represented diversification, stability, and legacy. Ownership, however, came with friction. Early suggestions about relocating operations to South Carolina ignited backlash. Fans protested, politicians intervened. Stadium funding debates soon followed, raising uncomfortable questions about public money and private wealth. The controversy underscored a simple reality: sports ownership is as political as it is financial. As an NFL owner, he now competed with figures like Jerry Jones, Robert Kraft, and Stan Kroenke, where success is measured in championships, not returns. By 2024 to 2025, Tepper's net worth exceeded $20 billion. Today, David Tepper's legacy is set. The king of distressed debt, the architect of one of the greatest crisis trades in history, and now an NFL owner whose influence extends beyond Wall Street. David Tepper's journey is one of the most extraordinary stories in modern finance. It begins in a middle-class home in Pittsburgh. It moves through anonymous analyst roles and long nights studying broken balance sheets. It passes through Goldman Sachs, where talent met limits. And it ends at the very top: hedge fund legend, crisis investor, and billionaire NFL owner. He did not rise in easy markets. He survived recessions, controversy, investigations, and periods of decline. When others protected reputations, he protected conviction. And when the world panicked in 2008, he made one of the boldest bets in financial history. That single decision earned him the title King of Distressed Debt. David Tepper didn't succeed by avoiding fear. He succeeded by studying it. His greatest returns came when markets were frozen, when headlines screamed collapse, when capital ran for safety. He waited, he specialized, he acted only when the odds were asymmetric. Leaving Goldman gave him independence.